What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 2nd of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to kick off the new year right and start with a sort of Bitcoin roadmap for 2023. But more specifically, not just focus in on where we think the bottom is going to be. That's a fool's gambit. More specifically, I want to spend some time to focus in on how we should generally approach investing in 2023 to become successful investors and traders in Bitcoin and the rest of crypto. Because I think there's a lot of misconceptions that people have about what is guaranteed when it comes to Bitcoin. We got a lot of things to dive into today's video. If you happen to enjoy the video, drop a like. It's one of the greatest ways you can support the channel. And let's go ahead and kick off the rambling session. All right, so I want to go ahead and, as I emphasized, not focus so much on price, but talk about where Bitcoin is right now. Bitcoin is an asset like anything else, and assets have emotional waves that they go through when it comes to their valuation and therefore their price. And Bitcoin is not the only thing that's getting hit right now. I want you guys to understand very clearly, I'm not bearish on Bitcoin in the long run. I do believe in the potential of Bitcoin and crypto, as well as generally being optimistic on investments and assets. Assets generally appreciate over time. They serve as inflation hedges. But I want to talk about why Bitcoin and the broader crypto space, including altcoins, as well as the broader equity markets, with names like Tesla, Apple, and FANG stocks, are going through a transformative period that only happens every decade or multiple decades. So let's go ahead and talk a little bit about what's really going on here. There are three key charts we're going to be diving in today. The first one I want to focus in on is talking about the NASDAQ composite. Now, this is one of the three leading indexes. You got the Dow Jones, the S&P 500, and the NASDAQ, which really measure the broader equity performance in stocks. Now, I know this isn't directly involved with crypto, but I really want to emphasize that there is a practically direct correlation to what's happening now in the stock market and what's happening in crypto, because both are respectable asset classes, albeit with different degrees of risk. The key thing I want to talk about, though, is that this is a chart that we sent out in our newsletter back as far back on July 30th or August 1st when we sent out the August edition of the Dash Report. And the chart has continued to hold true here as the NASDAQ has been practically pressing down to new lows. So let's go ahead and dive into this chart and see what it can tell us here about where crypto is right now. So analyzing this, I just want to go ahead and turn off our drawings here. And if we just take a look overall at price action, we can see some really interesting things. First off, that over time, as we discussed earlier, numbers generally go up and to the right. Generally speaking, assets appreciate over time. And we can see that the NASDAQ, which is more of the high risk, high growth area of the equity markets, has been performing phenomenally well in the long term. But it is important to note that while things generally go up and to the right, sometimes they go down to the right, and quite brutally, cutting down years worth of gains. And not to mention giving people an investment opportunity where for years they don't see a return and could face dramatic losses if they don't have the time frame to wait. And this is why, again, as I pull back here in our drawings, I want to go ahead and emphasize what's really going on here. What we're seeing right now is something very akin to what we saw in the 1970s to the 1990s. We're going through a transformative period, or we went through a transformative period during the 2010s of exponential growth in software adoption, hardware growth, and efficiency through all types of different innovations. We saw the advent of things like e-commerce. We saw smartphones, social media, advanced semiconductors that power our computers and mobile devices, biotech, etc. The innovation felt limitless at some points. But what we started to see towards the past couple of years were not only exacerbated valuations and expectations for these companies, but on top of that as well, we really started to see a lack of innovation at the same time. There is no coincidence playing out here. This is what happens throughout history, and we've had it happen before. It happened during the 70s to the 90s. We went through a multi-decade uptrend, where the uptrend generally was pretty consistent over time, as obviously these technologies added value to our economy. But as time progressed and the trend got bigger and bigger, well, our expectations of that technology got a little bit over-exacerbated. And that is what happened from 1998 to the peak in 1999, right at the turn of the millennium, the peak of the dot-com bubble. Now, this, again, maps out the emotion of bubbles and how things can start to get exacerbated and break away from the trend. Our expectations start to get too far out. And just like back in the 90s, when everyone thought the internet and its current state at the time was going to transform things, even though the companies weren't making much money, and a lot of these technology companies, in fact, were burning through capital at the same time with little to no chance of building a serious revenue model, we've had the same play out. While there's a lot more stable businesses here, and we didn't have as much of a euphoric breakaway as we had in the dot-com bubble, we had a lot of companies way overvalued with limited growth potential that in reality couldn't expand further than where they were. How was Zoom going to grow more, for example, than it could during the pandemic when everyone was forced to be locked down? How is Amazon going to grow its revenue exponentially after everyone being forced to basically buy things online? And that's the key point here we need to understand. Exponential waves of technology have blow-off tops. And these blow-off tops are usually followed by crazy corrections to the downside. And the dot-com bubble was a 78% decline. We think that there's at a minimum going to be a 50% correction here. And that brings us down to a valuation of $7,000 or 7,000 points, to around 8,000 points on the NASDAQ, meaning we have still got a ways to go from the current 10,800 point range. So this is one key piece here, and it has a lot to do with crypto because crypto as a sector is more than just Bitcoin. It's DeFi, it's NFTs, it's the metaverse, play to earn, all these different trends. And I gotta be honest with you all, I think we're gonna see some of those trends die in this bear market. And a lot of altcoins, a lot of cryptos that we think have value inevitably go to zero. An important metric to remind you of in this chart that we're looking at, over 98%, around 98% roughly speaking, of the IPOs, the initial public offerings, or stocks that listed during the dot-com bubble related to the internet were vaporware, and they disappeared in the next coming years. Don't think the same can't happen to altcoins, folks. You gotta protect yourself. I know there are a lot of moon boys out there who will tell you, oh, it's guaranteed everything's gonna go up, but we've gotta be prepared for the worst. That's what differentiates us here on the channel, and it's hopefully what differentiates you as an investor. It's gonna help you to stand out in the long term. Now, let's go ahead and talk about the next chart here. This is another really interesting one around equities, and it's the NASDAQ composite divided by the S&P 500. You guys can type this symbol IXIC divided by SPX. Now, what's really interesting about this chart is it signifies, again, as we talked about, that there are periods of risk-on activity and high growth expectations. And when we are in one of these periods where there is high growth and high expectations of continued future growth and potential, we tend to see a repricing. We see that equities that are more risk on tend to trade at a higher valuation and outpace their other kind of brother indexes that are more simply passive and more predictable business models. The S&P 500 is made up of the top 500 companies in the US that are publicly traded. And this has a wide range of sectors and implications, but generally it's more mid-risk versus the NASDAQ, which is more high risk. Now, you could probably do something similar to this to divide the NASDAQ by the Dow Jones, but generally speaking, we see uptrends during periods of time when we're seeing a lot of this exponential growth. Apologies for my poor drawings there. But you can generally see that we have these clear uptrends that usually last somewhere around a decade. Sometimes a little bit more, sometimes a little bit less. But we can also see that we've repeated history coming back up towards a ratio where we were during the dot-com bubble between the NASDAQ and the S&P 500. And what happens after here? Well, we can see during the dot-com bubble, for 2 years, 2 long, brutal years, almost 2.5 years, we had a brutal decline in the performance of the NASDAQ versus the S&P 500. We came back to the base upward line, the fundamental line that should be in play here because these technology companies are doing much more innovative things. They're able to generate much more revenue than the broader stock market. And we can see again that in the long term, we should be on this uptrend line. But we have deviated far away from it like we have throughout history. And as we can see, this is the quarterly chart, bear in mind. Each of these candles represents 3 months of time. as you can likely guess, we've got a ways to go before these technology plays are at a valuation that we can start to justify as a reasonable valuation. I've got marked here on my chart that we're expecting, roughly like a 38-40% decline, give or take. We're not trying to pick absolute bottoms, but this tells us here that we've got a ways to go, even if the stock market even potentially bottoms, before we really start to see technology plays, including cryptocurrencies, being a good buy. And again, I say that as someone who's a big fan of crypto. I'm just trying to be realistic here. We likely need to see a deviation below the trend line for fundamental valuation investors to come in and save the day. There's one other big chart that I want to talk to you guys about, because I know a lot of you are probably saying, Nick, okay, look, I'm not here to pick the absolute bottom. I'm here to dollar cost average. I'm here to buy when we're in discount territory. And I'm really willing to stomach no matter what happens here after I make these buys, right? I'm just going to buy at spot. I'm not using leverage or anything. I'm being disciplined. And I really want to catch the next bull market. And I think that definitely puts you on the better side of investors, guys. I mean, hats off to you if you're following that disciplined strategy. But there's one really important thing that I want you guys to be aware of. It's not meant to be mean or anything. It's just meant to face the reality, face the music, and understand that the last decade where buying the dip was practically a guarantee to make money, especially if you followed the 80% correction model. I want to go ahead and share a very important chart. And this right here is the Amazon-Microsoft chart. Now, this is literally if you were to just pair making investments in two of the best technology stocks over this past decade, right? Two companies that not only lived during the dot-com bubble, but on top of that, were able to come out on top as two of the best performers alongside Apple, Facebook, you name it, all these big tech names. I want you to take a look at this chart. We're taking a look at the monthly chart. So we're covering history from the 1990s all the way to where we are here today in 2023. Now, bear in mind, these two companies were two of the strongest during the dot-com bubble, and there's a reason why they survived into the 2020s. But when we look at this chart and the bear market that ensued in the dot-com bubble, I think people really don't understand how long it took before we started to see that next uptrend. Let's go ahead and turn on our drawings. This, generally speaking, was the period of time, 179 months, coming up on nearly 15 years from that peak until Microsoft and Amazon together, two of the best performers during the dot-com bubble and following through and materializing during the next tech run-up in the 2010s to the 2020s. 15 years before it got up to those previous all-time highs. And in between, lots of volatility, lots of scary price action where we downturned even to new lows in these names in 2008 and 2009 before shooting up higher. The ultimate question you need to ask yourself is whether or not you can stomach that volatility. Can you wait long enough? And more importantly, putting all that aside, all that kind of mental jargon, is it even the best place where you should put your money? It's not to say you don't have to invest or you can't invest. There are plenty of investment opportunities out there that don't involve the big tech names or even crypto. That's why we cover the macro perspective here. It makes us very different than a lot of people on crypto YouTube who are always just perma bulls who started investing over the last decade and haven't taken the time to learn from history. If we don't learn from this, folks, I can tell you all, if you don't think Bitcoin can simply just push sideways, we got another thing coming to us. Let me emphasize one really big thing here, which is I know a lot of people are curious about, some people give me crap and stuff like, Nick, you're too bearish. You've talked about Bitcoin going down at 12,000 lower levels. You guys will probably notice my videos. I don't spend so much time talking about where I think Bitcoin's going. We've got the downtrend line. The trend is already showing us that we're likely moving lower. But put that aside, even if Bitcoin has bottomed here, it could just push sideways for a long period of time with no serious uptrend. So you're no real better off buying here today, right? Until the trend has confirmed itself that it's ready to move higher. Why stress? This is a very big theme that we talk about in our recent edition of the Dash Report. We're just sending it out here today. But generally speaking, we talk about this idea when it comes to Bitcoin and altcoins. Now, if you guys haven't heard about the Dash Report, it's our newsletter here on the channel. It's one of the greatest ways you guys can support the channel. But on top of that as well, it's really less than a cup of coffee each day when it comes to the cost of it. And you get so much with it. First off, you get the newsletter, which this month we focused heavily on talking about the altcoin space, where we could predictably find some decent range where valuation could start to bottom. We did the same, similar for kind of a Bitcoin roadmap. But as I emphasized earlier, you guys are going to get access towards a lot of really interesting charts like the one we talked about here months in advance sometimes from when we would talk about them here on the channel. We just want to give some exclusive content for those of you who make the channel possible. And we really start to go macro. We cover analysis on crypto, equities, commodities, Forex markets, the whole shebang. We try to find opportunity in different areas. But on top of that as well, you guys will get my trade alerts. You'll get the Dash Report discussion group where you can talk to the other hundreds of members within the discussion group that are huge people within the Dash Report community, some of the brightest minds we have. And on top of that, you guys will get exclusive market updates that we'll send out from time to time, a read along through the Dash Report where I go through and kind of verbally describe some of my key points from the newsletter. There's a ton of value that's in the Dash Report that can be really valuable for you guys in the long run. And I think, again, will help you to ground yourself in that mindset of a macro investor long term. So if you guys are interested, check out the link down below in the description. You guys can get 20% off if you sign up for an annual newsletter. I think that's probably one of the best ways to go about doing it. But if you guys just want to try on a month and then switch to annual, that's totally fine as well. And even if you can't do that, it's okay, guys, because if you can just drop a like, that's one of the greatest ways you can support the channel as well. But until the next video, everyone, thank you all so much for watching. I hope you all have a fantastic day wherever you are and a great start to the new year. Stay safe, trade smart, and I'll see you all in the next video. Take care, everyone.